Hello, my name is Jason. I'm a tutor with Chegg Tutors. Link to my profile is below. Today we're going to be talking about weighted average cost of capital. Now, to start, it might be easiest to go over a weighted average. So let's say we have a test and we got 70% on the test. And let's say we have another test and we got an 80% on it. So if test 1 is worth 60% of your grade and test 2 is worth 40% of your grade, what is your grade? Well, we can do an average by just taking our the value we got on our test times the weight of the test. So 70% times 60%, that gives us 42%. And then we can do the 80% times the 40% to give us the 32%. Then we add those together to get our average grade. Our average grade would be a 74% in this case. Now, if that confuses you, another way of thinking about it is like this. Say we had 6 tests and we got 70% on each of those 6, and then we had another 4 tests and we got an 80% on each of those 4. What's our average grade? Well, we can add up our 0.7, 0.7, 0.7 the 6 times, and then our 0.8 4 times, total all those, that should give us 7.4, and then we can divide by 10 the amount of tests we took to get our average grade. So 7.4 divided by 10 tests equals 0.74. So on average, we get a 74% each time we take a test. That's the basics of a weighted average. Now, if we were going to apply that to cost of capital, let's say we had return on equity of 10%, meaning that for every dollar investors invest in our company, they want 10 cents on it each year. And let's say the required return on debt is 5%. So every dollar of debt someone invests in our company, they want 5 cents each year. And let's say equity makes up 40% of our firm value and debt makes up 60%. What's the average required return on our firm? The weighted average cost of capital, in other words. Well, similar to the test, we can just take 10% times 40% to get 4, and then 60% times 5% to get 3. Then add those two together and it gives us a 7% required return. Now, if that's confusing, another way of thinking about it is, let's say we invest $10 of capital in our business. 4 of those dollars came from investors, people like you and me who say, well, we'll give you money in exchange for an ownership in the company. And then 6 of the dollars were from debt holders saying that we'll loan you $6, but we want a fixed rate of interest every year in exchange for that. What's the required return on the equity and debt in dollars? So our required return on the equity would simply be our $4 borrowed times our 10% required return on the equity. So 40 cents each year, roughly, the investors would want. And our return on debt, calculated similarly, we have $6 of debt times our 5% interest, 30 cents in total. So when we combine those two, 30 cents plus 40 cents, we need 70 cents in total to pay off our debt holders and our equity holders every year. If we want that as a percent, we would just take 70 cents divided by $10 to give us 7%, our average required return. Now, the one other thing I'd like to go over when we're talking about weighted average cost of capital is the cost of debt. Usually, we want the after-tax cost of debt, meaning how much are we really paying after factoring in the savings on taxes that we have by having interest expense on our income statement. So if we didn't have any debt at all, if we were all equity finance, we would have sales of 100, cost of goods 60, and therefore our earnings before tax would be $40. Our taxes would be based on that 40, so we'd have, if our tax rate is 30%, we would have $40 times 0.3, or $12 we'd be paying in taxes. Our earnings after tax in that case would be the 40 minus the 12 to give us $28. Now let's say we had interest expense because we bought some, or we got some debt. So let's say our interest expense amounts to $10. That goes on the income statement, and it goes before taxes. So any amount of interest expense we have reduces the amount of taxes we pay. So in this case, we'd have 100 minus 60 minus 10, or $30 in earnings before tax. That would be taxed at the 30% to give us $9 in taxes. So because we had this interest expense on our books, we paid 12 minus 9, or $3 less in taxes. In other words, our earnings after tax here and our earnings after tax here, the only difference is the $7 that we paid in interest expense. Now, people are saying, I'm sure people are thinking that, well, we paid $10 in interest expense. Why is it only $7 effectively in interest expense? Well, that's because we would have paid $12 in taxes, and now we only paid $9 in taxes. So if our taxes were the same, our interest expense would effectively be $7. That's the difference in earnings between the two. So to formalize it, we can calculate our interest rate after tax by taking our cost of interest times 1 minus the tax rate. So in this case, 8% times 1 minus 0.3 to give us 0.056% after tax. So for instance, to make this more concrete, if we borrowed $100, our interest expense each year would be $100 times 8%, or $8. But since those $8 are tax deductible, we're paying 30% less in taxes. So our effective interest expense is really only $8 times 1 minus 0.3, or $5.6. That's the one thing to keep in mind. It can be confusing at first. People don't always understand why our interest expense is reduced by the amount of taxes we're saving, but I hope I've explained that well enough at least. And once you got that down, the weighted average cost of capital isn't too difficult to understand. It's just like finding the average grade on a test, except we have to adjust our grade if it's debt. But if you have any questions over anything, feel free to contact me. Link to my profile is below. Hope you have a good day.